Recently, the US passed sweeping stablecoin regulations, setting the stage for dozens, maybe even hundreds of different digital dollars to flood the world. Central banks and governments everywhere are now scrambling to respond. Some are pushing forward new stablecoin legislation, while others are even considering launching their CBDCs on public chains like Ethereum and Solana. That's why today we're breaking down exactly how the rest of the world is reacting to the US's stablecoin play and whether it's ultimately bullish or bearish for crypto. My name is Guy and you're watching The Coin Bureau. First though, nothing in this video is financial advice. Everything here is purely educational content intended to keep you informed about the fast-changing world of crypto, stablecoins and CBDCs. And if you find value in this kind of content, don't forget to smash that like button, subscribe to the channel and ping that notification bell so you never miss an update. Now, let's start with Europe, specifically the EU. For years, the European Central Bank, or ECB, had a simple plan for the digital euro. Launch a tightly managed central bank digital currency, or CBDC, on a private permissioned blockchain, accessible only through traditional banks and payment processors. But history had other plans. The first warning shot came as far back as 2019, when Facebook announced plans for its own global digital currency, Libra. Suddenly, central banks across the world realized that their grip on money could be threatened by a private tech giant. And that's when European officials began working on a digital euro, with the ECB publishing early research papers in 2022 and 2023. However, the public reception was lukewarm at best, and the idea seemed destined to move at a bureaucratic snail's pace. Then, in July 2025, the United States passed the Genius Act, creating a clear regulatory path for stablecoins and unleashing a tidal wave of digital dollars on global markets. For many in Brussels, this was a wake-up call. If the euro can't compete, it risks being left behind in a world dominated by dollar-backed stablecoins. In August this year, reports from the Financial Times confirmed that the ECB is now seriously considering launching the digital euro on a public blockchain, possibly Ethereum or Solana, instead of a private system. ECB officials now say they are, quote, experimenting with different technologies, both centralized and decentralized. But, as of now, no final decision has been made on the path forward. But why this sudden pivot? Well, for the ECB, it's all about defending the euro's sovereignty. In April 2025, Executive Board member Piero Cipollone called for cutting stablecoin usage in Europe by introducing a digital euro, pointing to the adoption risks of US dollar-backed stablecoins, which now account for 98% of the stablecoin market, and could in turn undermine the euro's role in cross-border payments and domestic commerce. Still, not everyone in Europe is convinced. Recent ECB research revealed that Europeans show little real appetite for a digital euro, preferring cash and cards for everyday use. This is probably why the ECB has stated that cash isn't going anywhere, and the digital euro is simply designed to complement, not replace, physical money. But if you've been following our previous coverage, you'll know that some of the ECB's early papers openly discussed a future where private payments, especially cash, might eventually disappear, leaving everything tracked and logged on centralized payment networks. And despite the lack of public interest, the ECB is still moving ahead. The Governing Council expects to make a final decision on whether to launch the digital euro by the end of 2025. If they choose to proceed, the proposal will then go to EU officials for debate and approval, a process that could take another 2 to 3 years, assuming it even gets the green light. At the same time, the ECB is overhauling its broader settlement infrastructure. Under the Pontes initiative, a pilot launching in Q3 2026 will connect distributed ledger technology platforms with the Eurozone's core payment rails. Early settlement trials involving more than 60 financial institutions and 1.6 billion euros in tokenized assets have reportedly shown strong demand for digital settlement using central bank money. Make of that what you will. Next, let's cross over to Asia, starting with China. For years, China's approach to digital currency has been all about control. The e-CNY, China's digital yuan, has become a symbol of state power. Every transaction is programmable and monitored, flowing through central bank infrastructure. By 2025, hundreds of millions of wallets were live, and the system was deeply integrated with China's largest banks. But after the US passed the Genius Act, Beijing's financial strategists had to rethink their plans. Reports began to surface that China's State Council was considering, for the first time, a yuan-backed stablecoin. Now, while this might seem like a major shift, analysts widely agree that such a stablecoin wouldn't circulate on the mainland, where strict capital controls still apply. Instead, the plan would likely use Hong Kong as the testbed. The stablecoin would be tied to the offshore yuan, or CNH, and aimed at international trade and payments, allowing China to challenge the dominance of dollar stablecoins in global markets, but without loosening its grip on the onshore CNY. And this is happening all while China's e-CNY continues to expand on the mainland, rolling out new use cases like digital subsidies and programmable payments. Meanwhile, Hong Kong has become Asia's innovation pressure valve. Thanks to its one country, two systems framework, it's been able to court crypto exchanges and even launch green bonds on-chain. For Beijing, Hong Kong is a perfect laboratory. The mainland stays locked down, while Hong Kong soaks up international capital and technical know-how. It's a balancing act that gives China the ability to shape global crypto standards without letting the genie out of the bottle at home. But China isn't the only Asian giant rethinking its digital money game. Take Japan, for example. After years of regulatory headaches and bans on foreign stablecoins, the tide has now turned. Japan's financial regulator is now set to approve the country's first yen-pegged stablecoin, JPYC, backed by government bonds and bank deposits. This move could boost demand for Japanese government bonds, just as we've seen US stablecoins drive massive demand for treasuries, a topic we've broken down in detail right over here. Additionally, Japan is rolling out a major crypto tax overhaul. For years, Japan's crypto investors have faced some of the harshest tax rates in the world, up to 55% on gains. But now, lawmakers are moving to reclassify crypto as a financial product, which could slash that rate down to a flat 20% in line with stocks. At the same time, Japan's central bank is taking a careful approach to CBDCs, stating it currently, quote, has no plan to issue a central bank digital currency, and is instead focusing on upgrading payment systems and innovating in retail settlement. And then there's South Korea. Earlier this year, Korea's banks and lawmakers turned their attention to stablecoins. Now, 8 of the country's largest banks are teaming up to launch a won stablecoin expected by early 2026, aiming to protect the domestic market from US dollar dominance. President Lee Jae-myung's administration is also pushing through a bold 5-part plan. From creating a comprehensive crypto law and allowing pension fund investment in digital assets, to legalizing spot ETFs and launching local stablecoins. But even as Korea ramped up its pro-crypto push, the country's central bank wasn't quite ready to step back. The Bank of Korea made it clear that CBDC development was still on the agenda, with Deputy Governor Ryu Sang-dae even describing a digital won as a, quote, countermeasure to stablecoins. Yet, less than a week later, the Bank of Korea announced it would be putting its CBDC pilot on pause, a signal that Korea's focus is firmly on fostering crypto innovation. And if you want to capitalize on all of this bullish development, then make sure to check out the Coin Bureau deals page. There you'll find exclusive sign-up bonuses up to $100,000, plus trading fee discounts of up to 50% and cashback offers as high as 75% on some of the top crypto exchanges. Just hit the link in the description or scan the QR code on your screen. And once you're on the deals page, check out all of our partner offers and click Sign Up Now to claim your deal. These offers won't last forever though, so make sure to grab them while you can. And now let's turn our attention back to the United States, the country that fired the starting gun on this stablecoin and anti-CBDC race. For years, the idea of a Federal Reserve digital dollar was the ultimate bogeyman in crypto circles. Critics warned of total surveillance, programmable money, and unprecedented state control. That narrative caught fire, fueling political pushback from both sides of the aisle. By early 2025, politicians, especially Republicans, rallied around the idea that a CBDC was a bridge too far, with Donald Trump promising there would be no central bank digital currency under his watch. With the stage set, the next chapter came in July 2025, when Congress passed the Genius Act, establishing America's first comprehensive regulatory framework for stablecoins. But the real story is more interesting than that. What the Genius Act essentially does is hand the keys to digital dollar issuance to private companies, banks, fintechs, and a new breed of regulated payment firms. Under the law, only licensed, permitted payment stablecoin issuers can issue US dollar stablecoins, and they have to back those coins one-to-one with cash or short-term treasuries. They must also disclose their reserves monthly, keep customer money separate from company funds, and prioritize user redemptions in the event of bankruptcy. Sounds like progress, right? And in some ways, it is. The Genius Act finally brings a clear legal framework to an industry that's grown to over $280 billion, almost entirely in regulatory limbo. For the first time, there are real consumer protections, transparency rules, and restrictions on what stablecoin issuers can do with your money. But here's where it gets tricky. All the surveillance, programmability, and transaction monitoring that critics feared from a Fed-run digital dollar hasn't gone away. It's just been handed off to private corporations. Under the new law, all stablecoin issuers must comply with the Bank Secrecy Act, meaning they have to verify identities, monitor transactions, and flag suspicious activity. Law enforcement can request data, and wallets can be frozen for compliance reasons, often without the same constitutional oversight that would apply if the government was running the system directly. In effect, digital dollars are programmable, surveilled, and controlled, just not by the central bank. Instead, it's banks and payments giants pulling the levers. There's also a long transition period. Non-licensed issuers can continue operating until July 2028, meaning the market will remain a bit of a Wild West for another 3 years. And foreign issuers like Tether are supposed to face the same tough standards, but enforcement details remain somewhat fuzzy on that front. Now, not every country is rushing to join the stablecoin surge or rolling out the red carpet for private issuers. A few major economies are charting their own course, some by doubling down on CBDCs and others by hitting the brakes. India is a perfect example here. The Reserve Bank of India, or RBI, has taken a steady and relentless approach to its digital rupee. From the first pilot in late 2022, the retail value of digital rupees in circulation reached just over $115 million by March 2025. And while that might not sound like much, it's worth remembering that India's income per person is still a fraction of what you'd see in countries like the US. Even so, the pace of digital rupee development is impressive, and the RBI isn't stopping at basic payments. They're rolling out programmability, offline features, and cross-border CBDC pilots. Over the past year, the RBI has opened CBDC wallets to select non-bank providers, and retail pilots now include 17 banks and over 6 million users. Yet, for all this momentum, the central bank is in no rush to go fully live. The RBI says it will only scale up as it fully understands the impact on users, monetary policy, and the broader financial system. Still, compared to many countries where CBDCs are stuck in the development phase, India's digital rupee is one of the few projects worldwide that actually seems to be gaining real traction. But if you consider the sheer scale of India's population, over 1.4 billion people, it's also clear the project has a long road ahead to true mass adoption. Canada, on the other hand, has recently tapped the brakes. For years, the Bank of Canada was deep into CBDC research, exploring everything from Bitcoin-inspired architecture to cutting-edge privacy techniques. But by September 2024, the central bank started scaling down work on a retail CBDC and shifting focus to broader payment system research. This was largely due to a lack of public interest, with recent surveys showing that Canadians overwhelmingly prefer cash and cards for everyday spending, and less than 3% use crypto for payments. Still, the Bank of Canada hasn't shelved the idea completely. In July 2025, it published a detailed blueprint for a privacy-first CBDC using cryptography to separate user identity from transaction data, and even proposing Bitcoin-style UTXO infrastructure. However, unless the public or Parliament demands it, Canada's CBDC will likely remain a contingency plan. Canada isn't alone, though. Australia has paused its retail CBDC efforts and is focusing on wholesale trials for now, while Colombia has also put its CBDC plans on hold, both countries citing a lack of clear public benefit and concerns about destabilizing the banking sector. Additionally, the Bank of England is now rethinking its digital pound plans, preferring to let commercial banks innovate in payments rather than launching a state-backed CBDC. And in the UAE, we're seeing a hybrid approach. The central bank plans to roll out its digital dirham by the end of 2025, while at the same time approving new licensing rules for stablecoin issuers, with both models set to run side by side. So then, what does all of this mean for crypto and your financial future? Well, in just the past year, we've seen digital dollars flood the world, stablecoins become household names, and governments everywhere scrambling to keep up. In some places, the lines between stablecoins and CBDCs are blurring so fast it's almost impossible to tell who's really in control: the state, the tech giants, or the people building the protocols. On one hand, the triumph of stablecoins in the US and the ripple effects across Europe and Asia look incredibly bullish for crypto's role in global finance. We're seeing public blockchains, decentralized infrastructure, and open standards being discussed at the highest levels of government and central banking. But as we've seen, the more stablecoins are integrated into mainstream finance, the more they start to resemble the very systems they were supposed to disrupt. Under the Genius Act, stablecoins may look permissionless at a glance, but the underlying controls, surveillance, and profit flows remain, with regulators and big corporations calling the shots. In Europe and Asia, meanwhile, policymakers talk up privacy, choice, and sovereignty, yet are ready to introduce programmability, identity checks, and even spending controls in the name of security or national interest. For everyday users, there's more convenience, more access, and sometimes, at least in theory, more choice. But there's also more data being collected, more financial behavior being monitored, and more risks if a major stablecoin issuer runs into trouble or if a government decides to pull the plug. Yet, even with all those concerns, it's not all doom and gloom. Crypto's roots are in open systems, censorship resistance, and decentralization, and there are still projects, developers, and communities fighting for those values. The Genius Act, for all its flaws, has put the brakes on many CBDC developments worldwide, and at the same time pushed countries everywhere to introduce clear crypto regulations for fear of being left behind in the digital asset race. When even countries as strict as China are experimenting with new ways to get in on the stablecoin game, you know we've entered a new era. So let's just hope that we end up with more freedom and not less control in the end. Okay, if you want to dive deeper into China's crypto policy, then check out our video on that topic right over here. And if you haven't subscribed to the channel yet, well, you can do so right over here. Okay, thank you so much for watching, and I'll see you again very soon. This is Guy, signing off.